Well, it's about that time right here on KAZ Radio. Praise the Lord, where we have one of the most hottest shows every single Sunday at 3. None other than What's Going On with Lady D and Sir John. Take it away, Lady D.
All right. What a wonderful afternoon it is.
Yes, much better than beginning of the week.
Well, yes, because we were powered out. But okay, we're not going to complain.
No.
Okay, it's
Lovely
still
Sunday.
winter. And I guess Mother Nature wanted us to remind us that, okay, the storm is not over yet.
Right, winter is still here.
Still here.
Right.
All right, well, not to further ado, I want to just welcome Mr. James Olivetr. I told you guys, I promised I was bringing him back for all your tax information, your tax questions. So get them in. Give us a call at 216-289-1554. You're more than welcome to tax if you can't get your call in. He's here to address
We're on
all your
Facebook,
little
so you
issues.
can go on there.
Okay, so take advantage of this because this is really good information. All right, so to get the show rolling, James, Mr. Olivetr, welcome back.
Thank you for having me back. It's
Yes,
good to be back.
Yes. Tell me, how's the tax business going? I know you're busy.
It has been a very busy season. It's been good. You know, it's a matter of trying to organize ourselves so that we can get everybody in who wants to get in.
Okay.
So, but it's been a good season so far.
Good,
All right,
good.
awesome.
I bet everyone had a lot of questions.
Yes, they do. In fact, one of the biggest things, of course, is they're wondering how is the new tax laws going to affect them for 2017. And actually, it does not, for the most part. There are about 2 or 3 things that affects, but the biggest things will be in 2018 and not 17.
Okay.
So,
What do we have coming up for that's going to be in effect?
Well,
That
now,
we're not going to have, that we have now that we will not have.
well, one of the things that number 45 did is that he did reduce some of the tax rates for some of the people. So if you were at the 10% tax rate, you stayed there. But if you were at the 15%, it is now 12%. If you were at the 25% tax rate, you're now at 22. If you were at 28, you're now at 24. If you were at 33, you only get just a percent off, you're at 32. If you're at 35, you stay at 35. And if you were at 39.6, you're at 37. And so those are the rates that are going to be in effect for 2018. One of the biggest things that they did in terms of the new tax codes, is that they have eliminated the exemptions. So let's say if you had a wife and a husband and 2 children with 4 exemptions, you now don't have any because they've eliminated that. So, and to reduce that or replace that, they've now have increased the standard deductions. And so there's kind of a compensation for losing the exemptions. Now you still put them on the tax return because there's still other things you can still claim. You can still get the child tax credit. You can still get earned income credit. You can still do daycare, but you cannot write them off as an exemption. So those are things that have changed. The other thing that I think a lot of people may not realize is, I thought is huge, even though President says that he's really for the middle class. One of the things that we will be losing for 2018 is, for an example, all the unions, what do unions pay? They pay union dues.
Right,
Okay?
right.
Gone. You will not be able to write off any union dues starting in 2018. If you are a salesman, let's say, for an example, you use your car for your business and you...
which most do.
Right, and you don't get reimbursed by your employer, you would fill out a form that says, okay, I drove so many miles,
Right.
give me... Gone.
What?
Okay, so basically all your miscellaneous expenses, for an example, like I said, your association dues, your professional dues, let's say if you are a nurse and you have lab coats that you cleaning for your uniforms, gone. So all those things for the middle class that they do as employees are now no longer going to be tax deductible.
So, and that's in 2018.
2018, correct.
Now, before I started working at the bank, I was on the road salesman.
Mm-hmm.
So I know that part, my deductions for the traveling I had to do because my sales area was huge.
Right.
From, northern Pennsylvania all the way to southern Michigan. Mm-hmm. None of that I could have taken.
None of that's going to be deductible. Or let's say, for an example, you took out a potential client that you're trying to get a sales with.
Right.
Okay, you take them out to dinner or take them to a theater. Won't be tax deductible for 2018.
So how do I get that money back?
You have to eat that? Or
Yes,
is,
you will have to eat that. Now, what I would suggest is that if you would talk to your employer and say, hey, now you know that at this point in our tax lives that we will not be able to write this off. What can you do to reimburse me since you haven't reimbursed me before and I can't write it off? So I think there's some room for negotiation.
So you have to renegotiate your contract with
Right.
your employer.
Exactly.
Same if you're like a nurse,
Right. A
or
police officer,
fireman, EMS.
EMS, any of those things, postal worker, because
Right.
they have to keep those uniforms.
The
and
wear and
stuff on,
tear.
yeah.
right, and or all the contractors, a plumber, HVAC guy, electricians who work in the union, they pay large sum of dues to stay
Yeah.
in the union, and none of that's going to be deductible. So none of their work clothes, none of the goggles, none of that gloves, none of that's going to be deductible.
That would be a
So, and that
huge
means
hit.
like really all union?
All
Because you're talking about you got the Board of Education, you
All
got
Teachers.
unions.
teachers union, and
every union in America, whether it be UAW, teachers union, you're a
union
labor
period.
union period, all your dues, or I should say, none of your dues will be deductible.
Deductible, or all the accreditations you got to take. If you're
Right.
like a teacher or
Continuing
social
education, yes,
worker,
exactly.
you
All-
have to get all these accreditations every year.
Right.
So most of that was deductible before.
Right,
So
so-
now it's not.
Right, so if you have continuing education, let's say for an example, see as an accountant, if I worked for an accounting firm and wasn't self-employed, say as a self-employed person, I can write off my continuing education. However, if I'm working for a firm, whether it be, like I said, a teacher, and I have to have continuing education, all those continuing education classes will not be deductible. Your travel to those places, let's say you went to Columbus to take a class, the travel won't be deductible, the food won't be deductible, the hotel won't
my
be
God.
deductible.
So therefore,
You know
your
how many
employer
they
is
have to
going to
do?
have to
But now,
build it. Your employer is going to now have to include that in their expense report. A budget.
right, so once again,
Or you have to renegotiate that.
Yeah,
They don't
but-
have
Oh,
to.
okay. Well, then that's part of when you take the job. Then you got to build that into your compensation.
So, here's a question for you,
Yes.
and help me understand something. This is for the individual, correct?
Correct.
These deductions that they no longer get.
Correct.
But for
Next
a
year.
corporation, they can get these deductibles. Am I
absolutely,
correct?
they still can get
Okay.
it.
So, would you not suggest that people begin to LLC themselves?
Well, the only way you can get some of those deductions, yes, is to become self-employed. And so a lot of these employers are not going to let you be an employee. And the other thing is that some people don't want to be employees because now you got to pay for your health insurance, you got to pay for a lot of other fringe benefits that you may not get as a self-employed person.
Pension, 401k.
Right. So those things. So once again, I think the better plan is to negotiate. I think with these unions, they need to get together and say, okay, what are we going to do now to negotiate with our employer since some of these things are no longer deductible.
And the next contract. Oh,
Right, but to answer your question, that's if the corporate structures, if they want to come off some more money, because now obviously they were saving money because they're not writing them off. So now you're talking about asking them to spend more money,
Right.
okay, than they're not having spent before. But the flip side is that they are getting a bigger tax deduction themselves. So the top corporate rate has now been reduced. So they do have a little extra money to spend. So that might be a way to say, hey, we know you have a little more money because your tax liability is lower for 2018 and 17. That's some money that you can help us save.
right, in our next contract,
Absolutely.
include these things in here, which
Absolutely.
they can write off then.
Right.
The corporation.
The corporation can write off, not on the personal. So,
But if you're like a subcontractor, or
but if you're a
it sound
subcontractor,
like-
you're an independent
Right.
employee. Okay, so if you can write it off on your Schedule C, but most of us, like for an example, police officers will never be self-employed as far as the city of Cleveland is concerned, or any cities, or firemen, or U.S. postal workers, or teachers. The school board's not going to let teachers become independent just so they can write off their
Right.
right.
well, unless we end up being like San Francisco,
Okay, well that's a
the
whole
only
yeah, but that's a whole different situation.
only city that has privatized police force and firemen and all that.
Right. Well, I don't foresee that happening. Ohio is a very, very strong, in fact, one of the strongest union states in the country. So they have a lot of unionization, and so
Right.
it is a very, very much a union state. So I don't see the privatization coming anytime soon in Ohio. So,
Well, that was an earful.
Yeah. So it looks like more and more, again, the tax code is geared for self-employment.
absolutely. That's still one of the best tax deductions that we still have left,
Okay.
along with real estate. But once again, with real estate, you got the headaches of a tenant. You know,
Yeah.
I remember on Christmas Day, I'm kind of in a festive Christmas mood, and so the phone rings and not paying attention. I said, "Merry Christmas," and someone says, "Mr. Oliver, my furnace is not working." I said, "What? Who is this?" So it's one of my tenants, and then so my next call had to be is to get one of my contractors and say to them and say, "Well, I know it's Christmas. I know you're probably celebrating, but I got a tenant that has no heat. Can you help me out?"
Right.
So for a fee, he did. So an extra fee, a little holiday fee. I said, "Okay, not much I can do." But I said, "There's give and takes in any situation."
Right.
So, but self-employment is you still have a lot of nice deductions. Now, one of the things that you won't have as a self-employed person, that entertainment, that's also gone for the self-employed person. So people who are self-employed who want to entertain their clients,
Right.
or potential clients. Let's say, for an example, if you have, let's say
A Christmas party.
Christmas party. No, actually, a Christmas party you can kind of do that, okay. But let's say on a situation where you have a couple clients that you want to take out for lunch, to maybe give them a presentation of what you're selling.
Right.
All right. Well, that lunch will not be tax deductible.
So you eat it.
Yes, you do.
There's no way around getting it to.
Well, once again,
I mean, because you break it down as a food expense, and
there might be some things that, once again, the good thing with the tax laws being what they are, when I say good thing, is that we still have a whole year. And I think one of the things that people have to realize is that the guy in the White House, one of the reasons why he wanted to rush and pass this thing in December, so he could say in the State of the Union address in January, this is one of my accomplishments that I can say,
Right.
and wave tote that flag. And in fact, the politics of this thing is that because of the fact that he passed it so fast, he didn't get the required 60 votes to make it permanent. So most of these things are temporary in the first place.
Okay.
And the second thing you have to remember is this, is that because of he passed it so fast, some of the constituencies, as they learn about this, they can still appeal to their congressional people
Right.
to appeal and say, hey, for an example, if the unions of the world, I guarantee you, started to come together and appeal to their congressional people, there might be just a technical correction and say, we didn't think about this when we did this, and so maybe we'll keep in, let's say, for an example, your union dues or association fees or some of the things that you write off, and we might put that back in.
Right.
So,
Because you do have midterms coming up.
right, you still have midterms coming up, and you still have a whole year to do this.
Right.
So those are two things that we have in our favor if we will come together and make those appeals to our congressional people and to the guy in the White House.
So of the new tax law, what affects now
For this year?
for this year?
This year, the three things that I would say that affect this year, for an example, if you have a lot of medical expenses, the last year in 2016, you had to have a threshold of 10% of your adjusted gross income. Okay, before that it was 7.5. So a couple years ago it was 7.5. It went up to 10%. So in the next 2 years it went back down, starting 2017 and 18. It will be back down to 7.5. Then it's going to go back up to 10%. So that's one of the things that's been affected in a positive sense. Another thing that was affected maybe in a negative sense is that for people who bought new homes and was writing off their mortgage premium insurance, okay, as an itemized deduction, though that has been eliminated. So you could no longer write your mortgage. And that was actually the third thing you could write off on your house. If you bought a house recently, you could write off the interest, you could write off the taxes, and you can write off your mortgage insurance premium. Not the insurance, but the premium. Yes, the MPI.
We have a question. We have
Yeah.
someone that's texting us a question.
Yeah.
Go ahead, Mr. James.
Okay.
What's the question here?
Okay, Terry K. Brown, who's watching, wants to know what do you suggest people who don't have children take deductions do in order to get a refund check? Buy property?
Okay, let me step back here for a second. Now, the goal, and it's not, and we talk about taxes. I don't want to talk about taxes in a vacuum, But the long-term goal for most of us is to become maybe financially independent.
Right.
And so one of the things that you want to consider is what are those things that you can do as a part of a bigger plan. So you have a firm foundation. You know, one of the things that, for example, CLE we talk about is getting people out of debt,
Mm-hmm.
reducing their taxes, building wealth, creating a legacy. So if that's the bigger picture, taxes is one portion of that. And so you don't buy a house or rental property for the tax deduction. What you're doing is buying it for the cash flow to make income. But in the process of doing that, you have some write-offs with that. So I would say you don't want to really per se just go into, or like having children. Well, you don't want to have children just have a tax deduction. I mean, that's crazy.
Right.
Yeah.
Okay? I mean, and all the tax deductions you can get with children, you know, besides the earned income credit potential, child tax credit, but that's not a reason to have a child.
No,
You know,
it really isn't.
Okay, so if you have that as your reason, I would suggest to rethink that position. Okay, so having said that, if you're really interested in owning rental property, then that would be, you know, as another cash source, another way of income.
Right.
Then the benefit of having that, whether you buy a house to rent it back out or you buy a house to flip it, so your primary goal is to make money.
Right.
So it's not to kind of save on the tax side of it, but in the process of that, you can write off certain things. But here's with anything else, if you're making an income, you kind of do want to have a tax problem, because if you've got a tax problem, that means you've got an income situation. And so you would want to have, the more income you make, the better, or the higher bracket you're in, that means you're in a better position to pay the taxes.
I have a question. So
Sure.
people who are unemployed, are unemployment benefits taxable?
They absolutely are taxable. Now, once upon a time, they were not taxable.
Yeah, that was quite a while.
But as I said, once upon a time, back in the Reagan days. That's
Right.
Okay.
And so, but they're now very much taxable. Every penny of it is taxable.
Now, what about those homes that were in foreclosed? Homes got foreclosed. How does that impact their taxes?
Well, it depends on the situation, and every situation is a little bit different.
Mhm.
If, for an example, that homeowner or homeowners were able to negotiate with their mortgage company, and let's say, for an example, they extend the time or to reduce the amount of the principal, then what happens is this: there's kind of a trade-off. The trade-off is that they get a break in the price of the home or the mortgage payment.
Mhm.
But the flip side is that the bank will now write off that on their taxes. And so what they do is they issue you what's called a cancellation of debt. Okay, the
Right.
cancellation of debt can be, could be 20, 30, 40, 50, 60, $100,000.
Mhm.
While in normal situations, cancellation of debt is a taxable event to you. So let's say, for an example, you had a car that got repossessed and they sold it, but because it was the amount that they sold it for didn't cover the value of the car.
Mm-hmm.
And so they will give you what's called a deficiency judgment. And a deficiency judgment now gives you, they also give you now what's called a cancellation of debt, saying that you still, we canceled in your behalf $10,000.
Mhm.
Well, that $10,000 you have to put on your tax return as income, even though you didn't get any money, you didn't get any benefit. So normally in that situation, whether it be credit cards, other store loans, a cancellation of debt is a taxable event to you. So now, with respect, there are some exceptions. A house, your own personal house, can be an exception. So if you negotiate it and you get a cancellation of debt, with respect to a mortgage company, there is a way to work it on your taxes that you don't have to pay taxes on it. But that's really the only exception. Any cancellation of debt of any other debt, for the most part, rental property, like I said, car loans, store cards, Visa, MasterCard, it is a taxable income.
That is
We
just
have
incredible.
another. We have another question.
Yeah, question.
Okay.
Social Security disability benefits, those aren't taxable, are they?
Yes, they are. Now,
Yeah.
if you are getting just Social Security, no, it's
No.
not by itself.
Okay.
But if you're getting other income, then it potentially
Like a pension.
Maybe the better
Right.
answer would be it depends.
It depends on the amount.
It depends on the amount. It depends on your situation. It depends on what other sources that you're receiving. That it could be taxable. It could be taxable up to 85% of it. So depending on what your other sources of income are. So there are thresholds that you have to cross over. Once you
Right.
cross those thresholds,
Right.
then, but if it's Social Security just by itself, No, it's not
Right,
taxable.
but yeah, because I remember I was told that with Social Security, it wasn't taxable, but any additional income up to a certain amount can become taxable. And I was also told that your investments, you can have as many investments as you want, as you know, and those aren't taxable. Of course, if you put them out, they are, but your investments aren't taxable as a part. It doesn't account towards your income. Is what I guess I'm trying to say for Social Security benefits.
That's
that
not
correct?
exactly true.
Okay.
We're talking about from the side of receiving Social Security.
Right.
Now, in terms of maybe getting Social Security, I'm sure everyone knows that Social Security is something that you receive once you get to your full retirement age, which is either 66, 65, or
Right.
67,
Right.
depending your age. Now, you can always receive Social Security early at 62, and you'll get a discount. So let's say, for an example, if you were entitled to the full retirement at your full retirement age was 66 years old, and say you were entitled to $2,000 a month, but you say, I want to get my Social Security early. Okay, I want to get it at 62. Well, then you get a 75% of that amount, so you would only get $1,500. But the other caveat with that is this: is that one, you only get 75%. The second thing is that your earned income that you earn from other sources, let's say if you take a part-time job or if
Right.
you're self-employment, is limited. For 2018, I think it's around $17,000. So every dollar over $17,000,
You,
it reduces your Social Security benefits by 50 cents.
ah.
Okay, now another exception, maybe it's what you were referring to. If you have investments, let's say rental property,
Okay.
you can earn $100,000 in rental property and will not affect your benefits at 62 years old for Social Security. However, if you work and make 17,000, it will affect it, but your investments don't affect it.
So you have to stay up under that $17,000 cap, that
with,
cap.
That cap with respect to self-employment activities or employment activities, but all your investments will not count against that.
Okay, so if you're getting that $1,500 a month,
Mm-hmm.
which comes to what, about 20,
18,000 a year.
18,000 a year,
Right.
and then on top of that, you can do another 17,000,
Right.
and not be
in terms of
penalized.
working, right.
Okay, got it.
Or, but I said, but if you have rental property, you can make as much as you want with rental property. You can make $100,000 and will not affect your Social Security benefits. Or you have $100,000 in mutual funds, you will not be affected.
That's
right.
good.
That's
Right.
the investment side of it.
That's
So,
good.
I wanted to note that some people sometimes think that at 62, because they get a discount on it at 66 or their full retirement age, then Social Security will kick it back up to the full amount. But that is not true.
Oh, they will not do that?
No.
No, absolutely not.
So once you pull from it, that's it?
That's once you
Pretty
get-
basically.
Pretty much it. Now, there's one small exception, is that you have a year, and this is why you should talk to financial people about these things before
Yeah.
doing this. Is why I encourage people. Sometimes people don't do that, and it could be, that's a lifetime mistake. If let's say you live to be 100 years old, you took it at 62, I mean, you've lost literally thousands
Of dollars.
thousands of dollars. But one of the things that you can do is something called a relook period or take back period. In other words, you have a year to say, okay, I didn't want to take my Social Security, and you can give it back, and then they will reassess you at a later point in time. So now, and actually, the story behind that is only a year. What it used to be, the look back period used to be 8 years. So in other words, and what happened was, the very wealthy kind of had this thing figured out. So what they would do at 62 years old, because they were already retired, they would start collecting Social Security. They would take that money, put it in an investment, put it in the mutual funds, put it in the stock funds, and then at about 69, they would call Social Security and says, hey, you know what? I didn't really want to take my Social Security. And Social Security would say, well, that's fine. As long as you give us back all that money that you collected, then you can start again.
Wow, they already built on
Right,
it.
so they made all this money, and so they just cut out what they owed Social Security, kept the difference, and then took Social Security at the higher rate. Now, of course, the flip side is this: at 66 is your full retirement age, but every year past that, you get an additional 8%. So if you were getting $2,000 and you waited till you were 70, now you can get I think it's $2,640 because it increases 8% every year.
Right.
And so the very wealthy, what they were doing is they were making this investment, you know,
Pay it back.
Pay-
keep the difference.
keep the difference, and then get the higher rate of 70.
Their money was making money for them.
Yeah.
Right. And
Right.
so I guess kind of
Smart.
say, that's a benefit that only the wealthy can really do. So we're going to do the look back period. Instead of being 8 years, we're going to just do it 1 year. And that just recently stopped about 4 years ago.
Right.
Wow.
Yeah.
Interesting. You know,
Yeah, because
now-
that was one of actually a plan of mine.
I'm glad you're talking about this because, like, I'm like,
Of course.
too. I want
What do you mean, of course?
Of course, John is an anomaly. He would have done it. Everyone else would not have done it. But the anomaly would have done it.
Yeah, that was part of my retirement strategy. I was like, might as well, then I, keep the difference, put
Right.
it back,
Right.
Smart.
Because
Smart.
the big thing, like I said, Social Security did not require any interest, just pay us back what we paid you.
Right.
So you kept all the difference.
I was very, very upset when they did that.
Right.
Got rid of it.
Yes.
Now, because of last year, we had a lot of disaster in a lot of areas, natural disasters. So if you were impacted by natural disasters in 2017, are there any tax breaks available to those folks?
Well, it's a situation by situation. Again, if the president declared it as a disaster area, there are some breaks. The other thing is that you also had a extended time to file your taxes because, of course, if you lost your records or the records were somehow
Destroyed or
damaged,
whatever? Okay.
right? So you had extra time to do that. So yes, there are some tax breaks with that.
So they can do an amendment then.
Right.
Okay.
Right.
Okay.
Absolutely.
Okay.
Absolutely.
Alrighty. And then, like, I have someone else asked me, so am I eligible for child and dependent care deductions
This year?
this year, or will that go away for
That's
them?
what's going away.
That's
No,
just
that's-
leaving?
no, that's
not-
staying.
That's staying. Now you have to remember, in the, our Congress people have, how can I say this in a nice way, crazy way of thinking about different things. For an example,
Yes.
a child, as it relates to taxes, have different ages.
Right.
Okay, depending on the deduction. For an example, daycare, childcare you're talking about, that's only for children who are 12 and under.
Okay.
Okay, so if the child is 13, then you can't do it. Now, in the year that he becomes 13, you can take it for the first part of the year till he becomes 13, and then you can't take it after he's 13. But now, for an example, child tax credit, the child definition is for 16 and under, so it's 4 years later. So earned income credit has two different ages. It has 19 and it has 23.
Right.
I was going to ask about that. That's
Right,
23.
so, well, the 19 is if the child does not go to college. If the child goes to college, then he has, or the parents have 23 to collect their earned income credit.
Okay.
So the definition for a child, or the age limit for children, depending on the subject matter, has different ages, depending on what that is. So,
Now, and can I deduct the cost of, if I was looking for a job, all my little expenses, spending my clothes and gasoline
in other words, if you're looking for a job,
and
and let's say for an example, if you were looking for a job, you have to look for a job, for an example, in your same area that
Your field.
you feel. So
Okay.
in other words, if I'm a teacher and I want to look for a job as a insurance salesman, we wouldn't be tax deductible.
okay,
However, if I'm looking for as a teacher, let's say across the country, if I want to say I'm teaching in Cleveland, I want to teach in California now, or maybe not California since they privatize it, but let's say Nevada. Okay.
San Francisco.
So, so that was, you could go out there, fly out there, get some interviews. So at the time, you could write off your travel, you could write off your hotel, you could write off the cost of your resumes, you could write off the cost of the food that you have when you're there. And so all that was deductible, but no longer in 2018. So job hunting expenses is one of those
So
other
this is
expenses.
the time to go, if you're going to be looking for another job in your field, take advantage of it now.
you have to do that now because next year you
Or
won't
last
be
year.
able.
No, that was
oh,
last
that
year.
was last year.
You had to
So-
do it
so
So
last
you
year.
didn't do it last year. You lost.
Right, so it used to be deductible, but it's no longer
Longer
deductible.
deductible. So this
Those
year
are one of those
4,
expenses that we were talking about, one of those miscellaneous expenses that you could write off, all job hunting expenses.
wow.
So that's one of the things that 45 cut out. So
Which is kind of weird since they're trying to make,
Well, what
Never
are
mind.
there,
well, I know those coal
Well, you know
miners.
what I'm saying.
Those coal miners going to be
Right.
looking for another job because the coal ain't coming back now. Even though he promised them that the coal mines are coming back, we have no use for that energy or that technology.
energy now.
Right. So I would suggest them looking for time to do some job hunting.
Oh, be careful. You know what happened to Hillary when she made that suggestion?
Right.
Well, let me ask you, Mr. Oliver. So, how do you find the value of non-cash charitable contributions?
How do you determine the value?
Mm-hmm.
Well, it depends on the actual item. For an example, let's say you want to donate a car, or let's say some jewelry or something very expensive. You can get an appraiser, a licensed appraiser, to appraise the value of that item. You record that, and then you would keep that for your donation, so that if I ever asked you, well, how did you come up with that determination? Because a lot of the things that we donate in terms of clothes,
Right.
whether it be shoes or suits, are pretty much very subjective to our
Idea of the value.
exactly. And so sometimes if you really want to be very, very meticulous, and in fact, actually, the best way, the absolute best way to do it is to take a picture of those items and list them by item to get the full value of those things, versus just put them in a bag and say, okay, I had 10 sweaters.
Okay.
Right, just saying clothes. You want to be
Uh-huh.
very, very specific. And I said the ideal situation, if you really are a little anal like people like myself, you take a picture of those things, and that way you can show proof. These are the things I gave away.
Uh-huh.
These are the value of those things. You know, whether it be shoes, suits,
I
sweaters.
need to take pictures of those
Right.
name brand
Household-
designer clothes and
Right,
stuff.
household items, absolutely.
Yeah.
Absolutely.
Because that all adds value.
Absolutely.
Right.
Okay. Yeah.
So,
So you can prove it to the tax man.
Yeah.
right. Now, I'm a little resentful that I have to do that, but that's one of the things you have to do in order to.
Well, that's
Justify-
covering yourself
That's,
too.
that's CYA, covering your assets.
That's right.
Okay, so.
Yes. Yes.
So-
Yes. Indeed.
Earn your assets.
I have
I love that.
actually a compliment here and a
Okay.
question
Okay.
Okay.
from Kathy Rothenberg James. That's my honey.
Okay.
Does he ever hold a tax class? I certainly appreciate his wisdom on this complicated subject. Do you hold any classes?
From time to time we do. Last year we held about 3 classes. They were at the dealership in Shaker Heights on Lee Road.
Okay.
And we talked about taxes, we talked about Social Security, we talked about retirement. So there might be another possibility of doing those classes again, since we had a pretty good response.
That would be great, James.
To do
Yeah.
And then we can let our listeners know, and they can show up, because
Right.
the more knowledge that you have of what you're spending and what's covered and what's not covered, because
Your
like you said,
liabilities.
every year it changes,
Right.
and you have to stay up on top of those changes. And the average person, if they're not a business owner, they don't stay. We just regular folks like us go to work every day. We're not keeping up
Right.
with that.
Well, see, and that's the other problem with, and I'm not trying to bash the TurboTax and the ones that people use, but the part of the problem that people have to understand when you use TurboTax is that TurboTax is a generic program. Okay, so it might hit 70-80% of the people, but if you have very, very specific situations, TurboTax is not going to address that. The second problem with TurboTax is that whatever you answer to TurboTax is always going to be right. It does not say, no, that's the wrong answer, or you didn't answer that right. And so when you answer a question wrong, you don't even know you're answering the question wrong.
Okay.
And so now you put it on your tax return, you send it in, and then you get a letter from IRS that says, hey, you did something wrong. But I went through TurboTax. I can't understand why. Well, because TurboTax does not evaluate your answer. They just take your answer and then
Put it in there.
put it in there.
Wow, that's interesting. No, because a lot of people are using they're quick, they're fast, they want to hear get their money back.
Right. But I've seen people who've used TurboTax, and when I looked at their tax return, because now they call me because they're in trouble, and I look at the tax return, I said, I can see why. Easily. There's all the stuff that you put on that you weren't supposed to put on. They said, well, I went through TurboTax. Well, I said, well, TurboTax doesn't tell you whether you're right or wrong. You said this is what it is, and they just put it on there.
Now, you've came out with this wonderful book, and it's a dozen expense tax mistakes that cost business owners thousands. This is a very good book, and how can our listeners get this book, or business owners? I mean, it's good reading for anyone, though. You don't just have to have a business.
Right. Well, you can reach me at 216-491-9350. That's 216-491-9350. Now, one of the things I talk about in that book, especially for those who are entrepreneurs, let's say real estate people are good ones. If you're very successful in your business, one of the things that people do not do, and I don't know why they don't do it, is that if you make all this money, you know that just as an employee, that when you get a paycheck, if it's $1,000 a week, you know you don't take home $1,000 a week. Your gross and your net's two different things. Well, when you're self-employed, it's exactly the same thing. You cannot keep all the money you make. Part of that belongs to the government. And so it is required that you are to make estimated payments. And so if you develop a system for doing that, then you won't be in trouble. But it's the opposite. If you don't develop a system, you will always be in trouble. And so one of the systems I talk about is having 4 bank accounts. And so people will ask, well, James, why do I need 4 bank accounts? I don't make that much. It's the principle. You need a personal checking, you need a business checking, you need a personal savings, and you need a business savings. So all the money that you make, you put into your business checking account. And so that will keep track of what you've made. And so as you're paying business expenses, if you're buying equipment, if you're buying paper, if you're buying computers, all that money that you use.
It's cut off.
Well, yeah, but now if you used your business checks or your business debit card, now you will have 2 receipts. You have the actual receipt, and then you have the banking statement that will reflect that. But now the problem becomes is when you take money out for yourself personal. Let's say, for an example, you want to pay the rent. Okay, well, that rent's a personal thing. It's not, even though if you have an office in the home, it's basically personal. And so if you need $1,000, then you really need to take out about $1,500.
Okay.
Because to get down to that 1,000, and the reason why is because you want to put 15% of that money, whatever you take out for yourself personal, has to go to Social Security. Another 15% will go to federal taxes, 3% to the city, 2% if you live in a 2% city. Cleveland's 2.25. So these are just estimates. Would go to the city that you live in. So you take 50, and that's about 35%. And so if you take that out, put that in your business savings account, then you'll have enough money. But so if you're taking $1,000 out and you take all that money out, then you only will have about $600 some odd dollars. But if you need $1,000, then you need to take more of that out. And so once again, you can also, we will help you with that. And so the money that you put in your business savings account, that is there for one purpose only. It's your holding account.
Taxes.
Right, and you do not touch that account. That is for your government. That's for the federal government, for Mr. Kasich in Columbus, and whatever city you live in. And so on a quarterly basis, you now take the money from your business savings account and you distribute that to all the agencies appropriately. So you do that 4 times a year. And then, of course, the other thing, why do you have a business savings account? Because you should be paying yourself 10% every time you take money out for it, and you build up yourself that way. But if you do that system and you keep that in place and follow that religiously, you won't be in trouble. But what I find is that people don't, when they come to us and say, I made all this money, I said, did you pay any taxes? No. Which is another reason, excuse me, why they don't want to file the taxes, because they know they're going to owe a whole bunch of money. And so, and it's required that the government to pay that on a quarterly basis. I had a independent
every business quarter.
Every business quarter. That's April 15th, which is the same day taxes are due as the first quarter. The next one's June 15th, October 15th, and then in December 31st. And so, I had an independent truck driver who decided, and I explained this to her, made it very clear that that's what she should do. And so the following year when I did her taxes, I said, did you pay your estimated taxes? She says, I didn't, James, but guess what? I got all the money for my taxes. I got it all set up in my savings account. I said, well, that's almost right, but you should have sent it in. She says, but I got everything. So when she did her taxes, she sent the check in, paid them all off. Then she got a little letter from her uncle saying, thank you so much for paying off your taxes, but because you didn't pay on a quarterly basis, now you got penalties, you got interest, you got negligent fees for not doing this right, and so she had to pay another $2,000 or $3,000. Okay,
just
money
not doing quarterly stuff.
Right, that's money just given to thrown away.
Free money.
Free money.
Another tax,
right,
in a sense.
Exactly.
I had a question about insurance,
Sure.
like life insurance. And I don't know how it correlates with your taxes. How would you if you have not the insurance you get from your job?
Okay.
Because if you lose that job, you lose that life insurance. But if you have your own,
Well, now remember, we have different types of insurance, and life insurance is one type.
Whole
You know, you got whole
universal.
life, you got universal, you got term.
Mhm.
Okay, in theory, though, none of those are tax deductible. But you have other types of insurances, like, say, disability insurance. So if you get hurt on the job, then you can, that's a tax deductible item, or workers' compensation. If you get, it's another type
So
of
if you
job.
work at a job, do you suggest that because some jobs offer some kind of like insurance like that, disability, as a
Like Aflac, for an example.
Okay.
You can invest in that. That's kind of a type of a disability insurance. So you can write that off, one. And two, it is obviously something that you can use as it relates to your job, because it does compensate you for time off because you're hurt. So, and Aflac is kind of a specialized, but there's other disability insurances that you can pay.
So you would use that after your insurance, your time has you've expired that time at work.
Right.
Because I know, like, they only give you 6 weeks or something
Correct.
where they pay you a percentage of your check. Because I had to use the disability, temporary disability,
right.
one time, a couple of times.
But
And-
but you should use insurance as a wealth building tool. It might not be an accounting building tool, but it is absolutely a part of a wealth building tool.
Oh well, how?
Well, for an example, there's several ways that you can do this. Let's say, for an example, now remember we talked about there's a couple different types of insurance. Let's say term insurance or whole life.
Okay.
Well, let's say, for an example, if you had, let's say you saved up $300,000 as an inheritance to your family, okay? And so, and now when I say inheritance, in terms of, let's say you put it in an IRA account, okay? So it's never been taxed, okay? And so at your transition, the family now wants to get that $300,000 because it's never been taxed. Guess who has their hands out?
Uncle Sam.
And
Uncle
you
Sam.
gotta pay a percentage of that.
You have to pay a percentage of that. And so let's say that you paid 30% or close to $100,000 to Uncle Sam for the privilege of getting that money out. Well, if you had an insurance policy for that $100,000 for that same amount, that insurance policy, which is now tax-free, can take the place of the money that you paid in taxes, and so that person is, or persons, is still whole because they used the insurance to take cover for the taxes. And so, so there's two reasons that people do insurance: for people you love and people you owe. And so those are the two biggest reasons. And once again, you'd want to talk to, and depending on your situation, term insurance is very, very different than whole life insurance.
Right.
And the statistics say that people who have term insurance, very, very few of those actually cash in on those term insurance policies. Well, part of the reason is because what happens is that when term ends and then you want to renew it, every time you renew it at a later age, it becomes more and more expensive.
Right.
Whereas whole life doesn't have that problem because you can kind of, it doesn't have a term that ends. That's why it's called permanent whole. And so you can maintain it, but it's more expensive. And so once again, there's several things you have to weigh. And to answer that question here on the radio, it really depends on someone's situation as to whether you want to take whole life or you want to take term. Now, there are those who feel that you buy term and invest the difference. Well, that works if you invest the difference. Most people do not invest the difference. The other thing is that once again, the bigger picture, if you're buying term, that you want to become self-insured. Why? Because of the fact that, let's say, for an example, because if you buy term insurance at 25,
Right.
whatever the premiums are, they're going to be a lot more different. If you do it every 10 years, and let's say you're still alive at 75,
Right.
try to get a term life policy and see what it costs for the next 10 years at 75 years old.
It's gonna lot.
It's going to be tremendous. And so now if you accumulate enough assets that you can really replace that term life, that you don't have to renew it. So that's really the ultimate goal if you're buying term insurance. The ultimate goal, if you're using term because it's cheaper, is to be able to replace that. So when it gets too expensive, you've got enough assets to cover the amount or what the insurance is paying for.
All right. So with term, when the term ends, if you never renew it, you can't cash it in.
Interesting.
That's correct. Because there is no cash value with term. Now, whole life, there is a cash value.
Right.
But see, here's the other side. And as I said, we could talk about this for hours.
Mm-hmm.
The whole life has some benefits with respect to an investment part. However, part of the problem with that is this. One, it's a very poor investment.
Whole life.
Whole life is a very, very, if you're using it for investment purposes, it's a very, I mean, it's better than nothing, but it's a very, very poor investment as it relates to investments. In fact, I had a client who came to me Thursday, and she was really very upset, and she says, James, you know, I'm really, really upset. I've been paying $29 for the last 30 years on my insurance policy, and now my insurance company has called me and says I owe $200 a month for this policy. And so she had some kind of universal policy because she had built the cash value, but because she was still paying $29, they took the cash value to supplement what her premiums were. And so now that all her cash value was gone. So the cash value that she thought she had, she no longer had, one. And two, she now has to pay a bigger policy. And so someone who sold her the policy.
It was a universal?
It's probably a universal policy, some type of universal or
Right.
variable policy. But no one sat down to explain with her, this is how this insurance works.
Wow.
And so now, it wasn't a big amount, but it was an amount still. You know, so now she's kind of up against the wall, you know, paying this bigger amount to keep her insurance policy. And she's 80 years old. So it's not like she's going to drop them and then get another policy.
Right.
She wants to keep this policy in force. She wants to-
Dear.
So a whole life is much better.
No, I didn't say it's much better. It's much different. That's like saying, is a Mercedes better than a Volvo? Well, no, it depends on what you like and what you have. But once again, you have to understand your needs, what your goals are. You know, so there may be occasions that you may have a whole life policy. Maybe term works better because it is cheaper. You know, for a young family, term is you can save a whole lot compared to a whole life policy doing term. But there's some other things you need to do with that so that you can have the wealth that you want down the road.
line.
So there's a bigger picture that you have to figure. Just buying term doesn't do it in
Then
itself.
you have to do something else.
That's correct.
So with a whole life, do you suggest a whole life that is fixed, that doesn't become a universal, or you don't go towards a universal?
Well, once again, it's an
It's
individual.
according to the
I'm just,
individual
I know,
and
I'm
what
just,
what they're
I'm,
looking
I,
for.
I'm,
So
What
it depends.
they do.
So my question to you would be, what is your goal? What are you trying to accomplish with that?
oh, just make sure that my dad is covered and, you know, be able to cover things for my relatives out there.
Okay, so what you probably would want to do is to find out if there's debt or there's a certain amount of income you want to have, and say, okay, what's that value that I want to have at the end of this time period? You know, I need 100,000, 150,000, 200,000. Okay, so then maybe a life insurance policy would be appropriate, or a whole life policy would be appropriate for that, because I said it does not escalate like term.
Right.
Okay. But however, once again, it depends on the situation. You would have to look at it. And I'm not really an insurance person, but I'm just
Right.
saying in general.
I have a question. I have a caller. Go ahead.
No, I have a question.
Oh, okay. Because
Okay.
I have a question next.
Oh, you got
Someone
one?
has texted me a question.
Oh, well, go ahead.
Go ahead.
Okay, no, okay. My question is simple. For the tax deductions that my business gets,
Yes.
and I guess I need to know this. Should I have been doing it quarterly, or do I do it at the in January the 31st?
If you're doing
December 31st.
If you're doing estimated taxes, it really should be on a quarterly basis, and because once again, IRS can penalize you even if you have all the money when you do your taxes
Right.
to pay them. They can say that you did not pay as by tax law, which says you need to pay on a quarterly basis.
So then I should have it done quarterly with all my deductions.
Correct. Because but
Okay.
now remember, when I said this, it's that when you do this, the system, when I set up for this with respect to your bank accounts, you only take out money, when you take out money for yourself, okay, for personal reasons. Now, personal, it can be very, very large. Grocery shopping, rent, getting your hair done, you know, other things. Now, when you're doing business deductions or business expenses, there's no estimates on that because that comes right off. So you're really only estimating on the personal side because the business side is an automatic deduction. So yes, you are kind of figuring it out, but you're figuring it out on the side of the personal, if that makes any sense to you.
No.
Okay, for an example.
Well, let me ask you. Okay,
Okay.
like she pays me $50 to do a show.
Okay.
I take $17.50 and set it aside for my taxes. That's 30% or so, right?
Okay. Right.
So now, do I get deductions off of that $17 for the business, or no? That just goes straight into the.
Well, it depends on what arena it goes into. So if it's for Social Security and federal taxes, no. State taxes, you could probably get a deduction for it. So it depends on, what agency you're paying with respect to that. But let's say for an example, if you, if you're paying for advertisement to let people know about you exist.
Sure.
Okay, that money that you pay, okay, you don't have to pay estimated taxes on it because it's a direct expense. It's only money that you take out for yourself that you now need to do the allocation between the taxes and the personal expenses.
Okay.
So, for an example, let's say if you wanted to take a vacation, okay. Well, that's actually going to be a withdrawal. Let's say that vacation is going to cost you $1,500, and so that when you at the end of the year when you do your taxes, that $1,500 is going to be a taxable amount. And so now you say, okay, if I'm at the 15% tax bracket, then I need to take out 15% of that $1,500 for Social Security, another 15% for federal, 3% for the city. I'm sorry, for the state of Ohio, and 2% for the city. And so, technically speaking, you would need to obviously have more than $1,500 to come back down to $1,500.
That's what you were explaining at the very beginning when we were talking.
Right.
About the 15 and the $1,800,
Right.
$2,000
Right.
more
Right.
than what was.
Right.
Okay. I have Aisha sent in a message. She wants to know, what can you write off when doing a 1099?
Okay. Well, 1099 basically means you're self-employed.
Okay.
And so-
What can you write off? Okay.
Okay. So when you are an independent contractor or you're self-employed, there's a lot of nice things that you can write off. You can have an office in a home. You can write that off. If you're using a car, you can write that off. All the expenses that are related to your business, once again, I'm not sure what business she's in, but whatever business expenses that she has, let's say
Right.
she buys a computer for her business, she can write off her computer, she can write off her printer, she can write off the paper, she can write off the toner, she can write off, even with her home office, she can write off the chair, her desk, the papers, the pens, the paper clips. So those are all things that she can write off with respect to her taxes.
And having those receipts to prove
And
that
keeping the
stuff.
receipts.
Keeping those receipts.
Right. That's it. Once again, if you have and use your business checking account, you'll now have 2 receipts. Even if you lose a receipt because you use a business check or your
yeah.
debit card, you can go back to your bank statements and see, there it is. So now
It's
you
all
have,
itemized.
it's all itemized. So
Excellent.
that's the best way to do that, to keep track of the records of that.
And I hate to go back to my other question,
But this
but
yours.
this is some different.
Okay.
Pre-planned funeral arrangements.
Okay, what about
Those plans, are those tax deductible?
funeral arrangements and marriage is, you say doing a marriage for your daughter, those are not deductible items. Funeral arrangements, they're not. Okay. So, but there is a way, a little savvy way, that you can get, just like private school, technically it's not deductible, but if you're a 1099 person or if you're self-employed, one of the things that you can do is you can hire your child. And in fact, that's one of the strategies that's in the book. You can hire your children in your business. You could pay them, for working with you in the business. Let's say, for example, you're a landscaper, and so you have your children work with you, picking up leaves, raking, cutting the grass, trimming, whatever. That money that you pay them, now you put it into their account. You use that money to pay for school. And so even though school is not deductible in and of
It
itself,
becomes deductible.
it becomes now deductible because you deduct tuition. Now, the other thing is that there's some other benefits behind that. One of the benefits, obviously, is that that child learns a little bit about work and the benefits of work. The other benefit you have is that by you paying your child, then that lowers your tax bracket, because now the expenses, instead of keeping it now, if you distribute, say you have 4 children and you've paid them each in a year's time $4,000, Well, that's $16,000 that you don't have to claim on your own taxes. That $16,000 could be enough just to raise you to the next tax level, but by distributing it to your children, it keeps it below that level. And for them, it's tax free to them, because the in terms of the itemized deductions, or I should say the standard deduction. Well, in this up to this year, because it's now $12,000 for every child, every person now gets the standard deduction of that amount. They could work up, really, you can pay them $12,000 not paying taxes.
Let me ask you, what is a split refund?
A split refund? Most people think of a split refund is where one of two things. It could be a refund that's split between two accounts.
Okay.
You notice you have one, maybe part of your refund go to your savings or another bank, or a split refund can be thought of as one from the federal, one from the state. So you have two different refunds from two different agencies.
Okay, and you're just allocating your money where you want it to go.
Exactly.
I see.
Right.
All right, and then let me see. Let me ask you your. I'm going to ask this question. So what? Let me see. What should I do if I made mistakes on my federal return that I haven't already filed? How do you get to clean that up?
Well, if you haven't already filed, then you just change the return. Now, if you've actually already filed, then you have to do an amended return. For an example, I had a teacher who was very anxious to get her taxes done, and so we did her taxes, sent them in, and she got her refund. And lo and behold, what came in was the tuition for her son, who was a freshman in school. And so that was a credit that she was entitled to. She also got another statement from a mortgage statement that came in late. And so what we had to do is to file an amended return for that extra money. And so she thought, well, is it really worth it, to go through all that? And so when she saw what she was getting back, which was close to another $2,800, she was elated.
Right. Okay, it was worth it.
Right.
And I'm going to squeeze this last question in here because we could just go on. I'm bringing it back. Okay. Tell me, if I'm already paying an installment plan to the IRS, am I entitled to get a refund, or will they keep my refund until I continue to pay off what I owe them?
Well, it's a situation by situation. It depends on how you negotiate. If you haven't negotiated the terms where you can still get your refund, they probably, if you haven't, they probably will take it. For an example, let's say if you have a student loan that you're behind.
Okay.
And that's with the federal government. If you're paying it on time, and you're keeping up with that, generally speaking, you will get your refund back. Now, but there's some terms, I said, it depends on how you negotiate that with the IRS. Because if you don't negotiate that, then, of course, they're going to take everything they can.
Oh, okay. So that's something negotiable you can talk with them about versus just taking what you owe.
Absolutely.
All right. Well, Mr. Oliver, we will be bringing you back here one more time in April because it's going to be deadlocked, get it all put together. And if you want to reach him, give us that number.
Well, here's one.
How can they call you and get in touch and set up some get their taxes done by you, or just see you?
Okay. What I want to talk about real quickly is
Okay.
this dynamic accounting firm that I'm a part of. It's called CLE, which stands for Creating Leading Enterprise Consulting Firm. One of the managing partners is Larice Purnell, Meltrice Sharp. They are an awesome group. We have put together today a fantastic team, and so our number that we can be reached at is 216-800-9021. That's 216-800-9021. And so not only would you get me, but you get our whole team of people to help you with your financial situation. And so, once again, it's a matter of trusting your limitations, because a lot of times people don't realize that they try to do things that they really can't do.
Right.
Got
So we will talk to you on a free consultation form, and we can help you out, because we don't always take everybody, but those we can, we will, and those we can't, we won't.
Well, thank you so
Once
much,
again,
Mr. Oliver.
CLE.
Okay.
CLE.
All right. Thank you so much, Mr. Oliver, for coming on. And that's what's going on with Lady D.
And Sir John.
And we'll be back next Sunday.
Have a
same
wonderful,
time.
beautiful Sunday. Blessed Sunday.
Okay, and get all your taxes in order.